Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Nike stock and do a stock analysis. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at individual stocks, want to get good ideas of potential stocks to buy, value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, you can leave it in the comments below, as a lot of the videos I do are based on subscriber requests. So getting into Nike here, this is kind of being so far in the value trap category for quite a while, as in 2021, it had a peak of over $170 here, as you can see in kind of the top right of the screen, and it's been falling, bouncing along the way, but creating lower lows, and is now setting at $43. So the real question is Nike a buy now, or does it potentially have lower to go? We're looking at first up some of the top level metrics here, the Guru Focus Value Bound, which basically is actually saying it could be a possible value trap. And sometimes this is right, sometimes it's not, but it is when it actually does start saying it's a value trap, sometimes you should, as they say, think twice. And we can see that they do have a P ratio. It's sitting actually relatively high still at 28.96. And the forward P ratio is a little bit lower at 23.49. And that means the analysts are expecting that EPS is going to be a little bit higher within the next year. They have got a little bit larger dividend yield growing, and that's at 3.76%. But you do have to kind of look at this dividend payout ratio, which is overrun right now. So we're going to go over if that dividend actually is sustainable for those dividend investors. So diving into the 30-year financials, you can see basically right now is that the revenue trend line before, this blue line here, was going at 7.78% per year. But in the recent years, basically, actually Nike's revenue has fallen. And while the analysts basically expect it to be flat for the next little bit, they are basically expecting it to pick up. At Nike, there's a few basically different headwinds that have been going on. They kind of did make this move, which obviously has turned out to be a bad decision, of kind of pulling out of the retail stores and going direct to consumer. And I think there was also their sales are being fueled a little bit by this sneaker reseller kind of culture that has kind of collapsed a little bit into a little bit of a bubble itself. So, that might be two of the reasons basically they've declined a little bit. And then there's these basically other brands like, I think it's Ona or whatever they're called, for some other running basically shoe brand that's kind of gone in and started eating up a lot of the market share. And that's because when Nike pulled out of the stores, well, there was basically new opportunities for other brands to get in there. And so, Nike's basically kind of is working on a little bit of a turnaround. And we're going to have to see if they're going to actually be able to pull that off now that there is more competition in the market. But getting back into the financials, you can basically see over the last 10 years, the growth rate per share has been about 7%, and the EPS right now has been a little bit lower at 6.2%. And basically looking at the top level metrics here, we can see return on invested capital has basically been dropping. Before, it used to be quite high for Nike. It's fallen down to 10% now, though this is still higher than their weighted average cost of capital of just over 8%. Looking at the revenue, you can basically see before they were growing in quite a nice trajectory, but then basically in 2024 or 2023, 2024, they kind of peaked and they actually started having a little decline in revenue, although it does look like they're plateauing to maybe get a little bit of re-acceleration going again. But you can see a lot of the big problem that has happened here, which I point out for a lot of different companies, is the gross margins. And the gross margins here have been declining. So they actually we're more around this 44 to 45% range, but now they're already down to 40.81%. So it's a little bit concerning to see that basically over the kind of the last year, they've get the sales basically flat. They've actually had to drop their gross margin a couple percentage points. This might be a little bit due to the tariffs, but this is still kind of quite a big drop, relatively speaking, that has been happening over the last several years. And then we look at their operating margin, well, that's also heading in the wrong direction as well. Because, well, the gross margin basically from, say, a peak of 44, maybe getting into 45, has dropped about 4%. The operating margin, where it did have highs actually in some years at 14, 15%, is already down to 6. So, while the gross margins have been shrinking, the operating margins have been shrinking as well, meaning basically as they're not growing their revenue and the revenue is either being declining or staying flat, while these selling and general admin is increasing basically at the same time. And getting into basically Nike's restructuring, I did look into what they're planning, and they are basically planning on doing a lot of cost cutting. So, above $2 billion. So you kind of have to think is when they're kind of going, hey, we're going to be doing some cost cutting, you can't be expecting a lot of top line revenue growth. And right now, kind of Nike is in a little bit of a troublesome area right now, as basically the gross margin is declining. And even if we factor that in, the operating margin is declining as well. as well. But one of the good things is they actually do have positive net interest income of $64 million. So they don't really have any net interest expense. So that's relatively very good for them. And that still is leaving them a little bit of basically bottom line income, sitting at $2.25 billion. But you can see from the previous years when they were getting around $5-6 billion, this is quite a large decline. And they're down to under 5% basically net margin, when years before they were hitting peaks of about 12-13%. And that's leaving them right now only with $1.52 EPS per share. And, that's basically overall being helped because they have been able to buy back a lot of shares. You can kind of see from 15 years ago, there was about 1.9 billion shares, and they reduced that share count, a reasonable amount down to just under 1.5 billion, 1.481. But one of the things, if you kind of know about Nike, they always kind of traded at a little bit of a premium multiple. So, well, the company did actually dedicate a lot of money to basically buying back shares. This necessarily hasn't decreased the share count at the rate it possibly could have if they were actually trading a little bit cheaper. And now that the stock has fallen a lot, it kind of looks a little bit silly to share buybacks in the last few years. Getting into the balance sheet, this is one of their strong points, though. As you can see, basically the current assets is sitting at $23 billion, and a lot of that is basically cash they're sitting on right now, or cash equivalents of marketable securities of over $8 billion. And if we compare that to our current liabilities, the current liabilities is only $10 billion. So this is quite a healthy current ratio. They have like around $13 billion of basically additional, basically a lot of it's basically cash or receivables or inventory. So that's sitting very healthy, and that, they have total assets of $37 billion. And most of that's just in like basically property, plant, and equipment. They have very little goodwill, basically only $240 million. So that's basically completely negligible. And so with such low goodwill, you won't be seeing them do a lot of non-cash basically write-offs, because they don't really have a lot of these types of intangibles necessarily sitting on their balance sheet, because you only get goodwill when you do acquisitions, and Nike really hasn't been, done any of that activity in the past. Now we can see the long-term liabilities. That's sitting basically only at 12, the long-term liability, total liabilities sitting at about $23 billion, leaving them about $14 billion of total equity, which mostly is tangible. And when we do look at basically their total liability, or total long-term liabilities at all, overall, you can see they do have a little bit of basically long-term debt, some lease obligations, but looking at the net interest expense, they are sitting in a very good spot. Well, if we scroll back up here, the line wasn't showing. Sometimes this isn't showing just because it isn't generating, but we do see that basically the net interest income is positive, meaning that any debt they do have is at a very low interest rate, and they're actually earning more on top. And basically that's the case for a lot of different companies, since right now, while the interest rates are high, they basically invest in short-term treasuries, and they earn a lot more interest compared to the actual debt they have, which is typically at a lot lower rate. And that's why they basically choose to do that rather than paying off the debt, since they actually make a little bit more net interest income. And then we get basically into the cash flow statement, and we can see a few interesting things going on here. So the one thing I'll just point out is basically the cash flow from depreciation here. And we can actually see for the last almost 10 years, it's been sitting around, $800 million. And while they were actually doing a lot more purchase of plant, property, and equipment in the previous years, kind of before 2020 when they were growing, they actually have reduced this quite a bit, and they're actually purchasing at a lower rate. So what we're seeing on the net income is kind of more real to what their actual free cash flow, potentially basically is, when we're kind of looking at that basis. But the one thing to keep in mind is you also have to consider, since they have kind of probably potentially underinvested in the reinvesting basically in their company, we may actually see this number basically increase in the future, since we do have quite a few years, which does look like they've basically purchased a lot less property, plant, and equipment than they have basically depreciated. And these numbers are actually a lot lower than even it was between 2016 and 2020. So that's one thing I would basically be watching for Nike, which will affect their free cash flow, is if they do start kind of reinvesting in themselves, which they might have to do, and buy more facilities and investments that into their company that way. We may see this number rise, which necessarily won't hurt the net income, but it will hurt basically the free cash flow. And you can see, so even though they're not a tech company, the stock-based compensation actually has gone up quite a bit in the last few years, sitting at over $700 million. So I think that actually is quite a lot of stock-based compensation. And the one thing you do have to keep in mind about that, they do need to basically buy back enough shares to basically offset the stock-based compensation, because if they basically don't do that, well, then the share count's going to be increasing. And if we go basically a little bit further down on the cash flow statement here, you can see that the share repurchases have slowed significantly. So even though they're basically sitting on a lot of cash and a lot of basically current assets on their balance sheet, because the company is kind of in this not good scenario now with their sales declining and their margins declining, and they're kind of trying to turn the basically company around and pivot it here, they've actually stopped doing their share repurchases in the short term, especially when the stock has been going down a lot, which is not actually a good sign for basically the price as it currently is. Since you would think if basically the stock is really cheap, they would be wanting to take a lot of basically that excess cash they have and buy back shares. And you can see what happened in the previous years, 2022, 2023, 2024, 2025 even. They bought back billions and billions of shares. And now that the stock is at the lowest price, well, now they're not buying back any more shares anymore. So I would say this is kind of like a negative signal the company is basically having. And you also have to realize now the share count possibly is going to start creeping up a little bit, as they do basically have the stock-based compensation, which isn't being offset by the repurchase of shares. And other than that, we can basically see that the dividends, they have been increasing them. And typically one of the last things the companies are basically going to do is they're going to cut their dividends. Because you can see right now, the free cash flow is actually sitting quite low at only basically $1 billion. And while previous years it was 3 billion, 6 billion, 4.8 billion, $4 billion there. If they were to even start getting this up, and even if we just look at what the net income from continuing operations is, which is $2,250,000,000 there basically, and kind of ignore all these other changes in payables and working capital, and kind of look at this just to pay the dividend. Well, we can barely just cover the dividend as it is right now. So that kind of does show that they really probably don't want to allocate a lot of basically repurchasing the stock, because they want to be able to basically use any free cash flow they are getting to basically pay this dividend. Since, right now, Nike's basically fallen a lot. What was sending a really bad signal to the market is that they actually basically cut the dividend as well. So anyways, I wouldn't necessarily expect them to be cutting the dividend, because they do have that extra surplus basically of cash, but I wouldn't expect any aggressive raises in the near-term future from here going forward. And unless they really do get a very quick turnaround and start showing a lot more free cash flow, I wouldn't expect these share repurchases to start anytime soon again either. So getting into the interactive chart here, we can kind of get an idea of relative evaluation. And you can see right now, these are based on the analyst estimates. And the one thing is, once you've already had a basically decline and a plateau, and then even for the next year, they're just still expecting a kind of a plateau. It's kind of sometimes a little bit, I don't quite always trust it when I see basically, oh, well, they're just going to resume their normal trend. Because basically what this is assuming is, oh, they're going to implement their turnaround in the next year, and then they're basically off to the races. And we can basically see that with EPS with estimate as well, of that, oh, basically the net margin is going to start increasing, and the EPS is going to basically start flying up. And I kind of looked at these numbers a little bit more, and basically the numbers they're expecting to get to back here would be assuming they do get to a net margin of 12%, which was on the high basically side before. So I do think this is a relatively optimistic turnaround that the kind of analysts are projecting. Although, just keep in mind, a lot of times these last couple of years here, there's only usually one or two analysts covering it, so they're not necessarily as accurate. And, well, for more predictable companies can be more accurate. When you're kind of facing this turnaround situation like Nike, well, you kind of have to really take these types of estimates here basically with a grain of salt. And now let's get into a little bit of the other valuation. We can kind of see the price to sales ratio sitting at 1.39 right now. And historically, this has been actually pretty close to the lower levels during basically the 2008-2009 great financial crisis. It goes down to 1.09. And it has had other points where it was lower, such as in 2000, went to 1.85. So we kind of are reaching these more basically extended levels for the price to sales ratio compared to what has been in the past, which kind of could be signaling it is getting into a better value. And we look at the P ratio, basically, because the earnings aren't so great right now with the margins basically collapsing. They're sitting close to this 29. And, historically, the problem is a lot of this time here when they were doing this run up, it traded for such a high P ratio. Even these areas here in 2023, you were trading between even on the dip, still a 30 P ratio, which is definitely not cheap. And going back, you can see in 2017, they hit maybe here before low, the big run up, P ratio of about 20. But you kind of have to think in the mindset of this is Nike. Everything was going good for Nike when it was basically being valued on the low side of about a 20. Yeah, about a 20 and about a 30 on the high side. And in 2009, they went down to about 11. So I do think that you kind of have to say that, well, just because they were this PE in the past does not mean necessarily they're going to be that type of PE going on the future. Because if we kind of bring up again this revenue with estimate again, during all this time, the revenue growth was actually, quite good, quite aggressive. And the EPS growth as well was actually going quite good along all this time. And they hadn't basically had any of these big contractions basically like this, of these multi-years basically of EPS going down and even the revenue going down during a non-recession year as well. During 2020, it's kind of understandable because we all know what basically happened then. Even 2008, 2009 here, when the price was basically lower on a price to sales and a price to earnings, well, the EPS really just plateaued at this point, but the revenue was actually increasing. So they were kind of relatively actually doing much better in all these past periods of time than they are right now. So you kind of do have to take that level that the company is much more distressed, and you really do kind of have to bet on this type of turnaround happening. And if we bring up the dividend yield, well, the dividend yield is basically going to be at a relatively high point because, well, they're almost paying out basically all their free cash flow right now. And also, before they, definitely were not a high dividend paying stock before, and they had a higher valuation. So you really can't use this, in my opinion, as a relative analysis either. So we're getting in basically to the stock chart here. You can kind of see this long trend, and you can kind of see this like slow channel we're going down. And I think it's very possible that the stock basically continues basically trending down channel until there's a very clear, definite, basically clear signal that the company is turning around. Since I'll get into my little basically, this isn't a discounted cash flow calculator, it's kind of the discounted earnings estimate calculator. And well, the earnings estimates basically only went to, I think it was May 2030 of 468. I just took kind of a projection of what that one analyst was saying and put it to $5 by the end of 2030 to kind of get an idea of what everything's heading. If we were to basically say, oh, Nike's at a 15 P ratio or 25 P ratio, if this EPS, which is probably very, very aggressive, basically were to occur, these are the types of returns you would basically end up getting, which I think for basically the amount of distress that's happening with the declining margins, these aren't actually all that overall attractive. Because if you do kind of say, hey, the EPS probably is not going to be as good, let's lower it down to a 3.5, you can see how it starts looking basically a lot worse. The company, potentially trades at a little bit lower PE, this 15 to 25, and it doesn't basically have this reacceleration back to all-time peak margins, more of a moderate recovery. And that kind of basically is saying that, oh, the stock really actually is very attractively priced right now. But where do I think it could be? Well, I just kind of based it on this channel and also gets to the price here of, where this price volume profile comes in. Could more be around this $25, $26. And you can see if we kind of keep these numbers here, and we were to say, hey, we're getting $26, then this basically starts looking a little bit more attractive, as we're now looking at potentially 30% on, compound annual growth returns, basically at a much more moderate, basically EPS estimate that doesn't require the company basically to get back to their peak margins. So basically overall, that's my, thoughts on Nike. I think basically they still aren't basically a buy. They may, get some bounces basically in the meantime, but probably even before they were to take off, I think even at these current prices here, if we just kind of reverse these up, we're not going to see any quick reversal anytime soon. Because if they were to basically start reversing, you think, hey, stock bounces here, bounces back up to, $60, $70. You can kind of see what happens at, $70 price point. Then you really don't have any upside in the stock on the very aggressive estimates to begin with. So if they basically were to bounce up like this, I would kind of expect them to come back down and kind of slowly work their way out of this bottom here if they were to actually start bottoming here. Otherwise, they may actually keep going lower unless there's a very clear defined basically turnaround. And, just like here, you can kind of see they kind of have these long periods of basically sideways chop. So anyways, Nike right now, like a lot of things, I have it on the watch list because it's a popular stock. It does have a very good balance sheet. The brand, does have a lot of longevity basically to it. And if they are basically able to get this turnaround basically going, stabilize their margins, and then we can kind of get a clearer picture of where that EPS basically, realistic estimate may actually be in the future. And at that point, then we can kind of actually calculate what would be a more accurate, basically, price target for it to get and the potential returns we could get from that point. So anyways, that's my stock analysis on Nike. I hope you enjoyed it. Make sure to subscribe to the channel and like the video, and I'll see you in the next stock analysis.